Hello, everyone. Thank you for listening to our analysis of Case Study 2 American Barrick to Hedge or Not to Hedge. The company first entered the gold mining industry in 1983 with founder and CEO Peter Monk. The company quickly grew to become Canada's eighth largest publicly traded company by 1992, which differentiated themselves amongst other firms by being predominantly North American based, which mitigated the risk of gold mining in South America and Africa. The company also differentiated itself from other competitors by adding value to shareholders by hedging against the gold price risk, which allowed them to optimize their returns and have a predetermined cash flow from production. Peter Monk was a young Canadian entrepreneur and financier with no history in the gold mining industry whatsoever, but he did see a demand for gold institutions that weren't subject to South African political risks, so he wanted to enter that market. He aimed to have a conservative financial policy by issuing very little debt and moderating the firm's gold price risk instead. This was due to the fact that he had a previously failed endeavor that was due to having a distrust of high leverage. There are four key components in the value chain in the gold mining industry, which included exploration, acquisition, and processing and selling gold. The company explored and acquired mines predominantly in North America, which eliminated the political risk associated with South African gold mines. A lot of the mines that the company would acquire over time were approximately close to each other, which allowed the company to cut down on cost and benefit from economies of scales. This allowed the company to use the same processing for multiple mines that were in the same area. The company also implemented both open pit and underground mines. The open pit allowed for lower mining costs and ore stockpiling, and the underground allowed for specific ore quality mining and allowed for extraction of ore from hard to reach places. American Barrick used hedging techniques to allow them to essentially set the minimum price of what they would sell their gold for, which allowed them to have a more consistent and forecastable cash flow. With the prices being predetermined due to these hedging techniques, this allowed the company to mine as much gold as possible as quickly as possible and allowed them to lower their operating and processing costs. Using these different hedging techniques was a great idea all up until American Barracks originally planned to produce 1.2 million of ounces of gold from the specific mine by 1995. But when the people that would produce the gold noticed that the gold mine was actually going to produce closer to 2 million ounces of gold annually, this created an unaccounted for production of gold that wasn't hedged against. So now the scenario was, are they going to hedge against that zero point 0.8 million of ounces of gold that wasn't originally accounted for? The company used different hedging techniques such as trusts, bullion loans, gold index notes, and then they went on to options and spot deferred contracts.
One of the hedging instruments used by American Barrick were trusts. Basically, royalty trusts were innovated by American Barrick. They promised investors a 3% to 10% cut of the mine's production um, when the prices of gold increased. This was used to raise a combined $67 million for expanding the Runaby gold mine and the Camflo mine. Basically, what trusts did is they American Barrick used trusts to pre-sell a 3% to 10% fraction of the gold at a fixed price. Um, they were effective in raising capital in that way because everybody wanted to uh, have that benefit of a 3% to 10% return on the investment. Bullion loans were another one of those instruments used by American Barrick. Uh, the company utilized bullion loans to help hedge against future inflationary effects. Uh, these loans help them discourage future investments if inflation sort of went up immediately or quickly or rapidly. Um, for example, in 1985, when they entered into the into a bullion loan agreement with Toronto Dominion Bank to fund the acquisition of Mercury Mine. They received American Barrick received 77,000 ounces of gold, which sold for about $25 million in the market. Um, this loans also helped them collateralize the assets of the mine, which were worth $54.3 million. Gold indexed notes were another type of instrument used by American Barrick. Uh, Under this instrument, they did not collateralize. The mines did not utilize were not utilized as collateral, just like in the previous example with the bullion loans. Under this instrument, gold prices of $400 per ounce were offered for $50 million in 2% indexed notes to euro market investors. So the investor, by paying $1,000, 308 per note, would receive interest payments of $26.18 annually. Investors were allowed to redeem the notes on specified dates, mainly between the February of 1988 to 1992, for cash or for gold bullions. Uh, this instrument was used to attract investors because it helped to minimize risks involved with uncertainty while maintaining purchasing power in the same time. Options were another type of instrument used to mitigate the risks associated with gold prices declining. This allowed American Barrick to retain some of the benefits when the prices of gold went up. The company used the call strategy, which allowed firms to simultaneously buy put options and sell call options at the same time. Adjusting exercise prices and ratios on the puts and calls allowed American Barrick the freedom to determine the degree of how it participated in the rising prices of gold. The type of instrument used by American Barrick was spot deferred contracts, or SDCs. This combined forward and option contracts to hedge future price exposures. Um, they gave option to either deliver on the contract or roll the contract forward, depending on the contract and spot prices. They help to realize profits for an increase in gold prices while maintaining a minimum price on the sales of gold. In this case, we saw that American Barrick had a duty to its investors that was mitigating risks in order to protect them. Uh, all the hedging instruments we just discussed, were used by American Barrick mainly to protect their investors and themselves from loss. Uh, Hedging instruments used by American Barrick also allowed investors to realize positive returns while protecting them from detrimental downside risks of investing. So, the uncertainty that comes with gold prices being volatile, and in general, the uncertain nature of investment, given that nothing is granted, makes many investors prefer the companies they put their money into, not use hedging instruments like the examples we went over, like the trust and the bullion loans and the spot deferred contracts and all that, especially when the commodity of prices such as gold is going up. Um, Given the fact that American Barrick has an enviable track record when it comes to using hedging instruments to its benefit, and the fact that there's minimal costs of capital at the Maker mine, and also the fact that unhedged commodities have proven to significantly drive down a company's stock prices, especially when the prices fall. We suggest that American Barrick hedge the current production windfall so that it protects itself against a future fall in the prices of gold.